Welcome, everybody. This is Across the Atlantic. We provide actionable insight at the intersection of geopolitics and capital markets. Today, I'm joined by Tomasz Nadrowski. Based in New York, Thomas is a portfolio manager at the Amvest Terraden Critical Minerals Fund. He is a CFA Charterholder with dual master's degrees from the University of Geneva. Thomas is a former director of the World Economic Forum, served as director at Anu Energy OEIC Ltd, and is fluent in 7 languages. He's the author of Mineral War, China's Quest for Weapons of Mineral Destruction, which explores how minerals, supply chains, and capital allocation shape national security and global power. He also hosts the podcast Tyranny Today, Geoeconomics, Geopolitics, and Geostrategy, where he provides insights into broad global trends and indicators of the spread of tyranny. Thomas, thank you so much for being with me this morning. Really appreciate it.
Thanks, Garrett. Great to be here.
Awesome. So, Thomas, for today's call, I'd like to do a little bit of scene setting, right? So we're going to be talking, obviously, about the bifurcation of materials, commodities, where geopolitics is splitting critical mineral supply chains into 2 parallel universes, it seems, right? So China's state-driven model versus a more Western private capital approach. Critical minerals, it seems, especially I feel like a lot of people understand this and feel this in today's, but have moved beyond just traditional economic cycles and have really become central to national security, but not just national security, but also tech supremacy and reshaping global power dynamics. So we'll take a look at strategic asymmetries, emerging risks, opportunities, and what it means for investors, policymakers, and navigating an era of mineral wars and, importantly, deglobalization. So, Thomas, we'll just start right off and get right into it. So can you help us explain a little bit, in your view, the West's strategy around critical minerals, China's strategy around critical minerals, and how China currently holds an asymmetry in the process?
Yeah, so there are many ways to answer this question, but I think there's something we should not really lose from sight is the ideological difference in terms of approach to how economy works in general. And then we can just zoom in back to critical minerals. But just on that, our view in our capitalistic system is usually that value is created at the moment of exchange of something and sort of percolates upstream through goods, capital goods into economic factors. That's not the Marxist view of how the economy functions. It's almost the other way around. That's about infusion of economic factors into the productive system all the way down to the market. Whether it's sales or not is sort of like of secondary importance. The Chinese system, as I observed it when I worked there in the 1990s, allowed sectors that are closer to the final consumer to be liberated, to be privatized, and welcome foreign investment as well, foreign technology, marketing skills, management skills, and so on. Foreign often meant Taiwanese, Japanese, Hong Kong, but also Western. That was not the approach for the upstream industries. The Chinese Communist Party decided from day one that control over upstream industries, and that includes metals, I would say it includes their obsession about metals, should remain within the broader controls by the Chinese Communist Party and by the state, which is sort of appendage to the party, and different levers that the state has, not least through state-owned banks. The largest banks are state-owned, and therefore they allocate capital accordingly as per the remit of the Communist Party. Now, metals, as I said, in particular, represents something of an obsession for totalitarian regimes. I quote the name of Mao Zedong's greatest hero. His name was Joseph Stalin. He changed his name from Jugashvili, a Georgian name, to Stalin from steel. Steel was a particular obsession for the USSR. It was no different for the PRC forever since. But beyond steel, there are other metals as well. And so when I worked for Anglo Gold, which back then was the world's largest gold company, and our mothership, Anglo American, had a large office in Beijing, we still hoped it would be possible to enter China, explore for minerals, and maybe mine them. It was never a plan of the Ministry of Land and Resources, as it was called back then, or the broader system. That sector was closed to foreign incursion. there were some openings for the private operators, but on the margin. The idea was to consolidate whatever there was private and make that sector state-owned and state-controlled and state-directed, which is exactly what has happened, and not just in critical minerals, but in other metals as well, and continues, both in terms of the actual ownership of assets, but also in terms of control of flows. A great example is this state-owned monopsony these days that controls the imports of iron ore. It wasn't like this before, but right now there's a state-owned monopsony. So everybody has to actually deal, every iron ore exporter has to deal with that state-owned entity that determines what the pricing should be, what's in the interest of the state, and therefore what's in the interest of the Communist Party. And so critical minerals, forgotten in the West for a number of reasons, those smaller markets, because we at Amvest Terraden Critical Mineral Fund, we consider critical minerals those smaller buckets. Usually they don't have futures markets, so specialty metals, rare earths, and some of the battery materials, they were on the periphery of Western capital's interest. Lithium, for example, did exist, but it existed usually as part of a portfolio of chemical companies rather than your typical mining companies. Rare earth business was killed mostly through regulatory overreach here in the United States. The Nuclear Regulatory Commission in the early 80s decided that anything that's over 0.5% radioactive, and that includes, of course, thorium, would have to fall under class 7 material, very complicated handling, logistics, trading, and so on, just way above the cost structure of any mining operator at that time. And so in a way, there was both a pull factor of this sector slowly migrating towards China, which for ideological reasons was so focused on metals in general. And there was also a push factor, as our capital didn't see the timelines associated with investment. This is particularly attractive, and we have examples, counterexamples of the structure of capital market that's extremely advantageous to certain sectors, whether it's biotech or fracking is the best example, when you have much shorter duration to cash and stronger depletion of capital. And for that, you're in Texas, so you would know. There is actually some commonality of interest between the way the capital market is structured. Not so much in the public equity market for mining in general in the United States, which is really a very marginal sector. In the US, it's a little different in Canada and Australia, and hopefully these sectors will eventually save us by nurturing companies that will have to be reborn and grown again to help us build or rebuild those industries.
Yeah, 100%. Well, and this is why I split the question up, honestly, because one, it's a mouthful, it's a lot, and it's a big question, but then you start diving in, Thomas, to that second point, right? So how does the asymmetry that's been created by a number of reasons, obviously ideological, as you mentioned, and others, but that asymmetry that they've created, how do you see risk and alpha opportunities for investors across the West, right? Obviously, this is taking place in the US, Canada, Australia, other places that are focused on non-Chinese critical minerals equities, right? And I say critical minerals, but it's like, as it's a larger space. So it's metals and mining. So you can span any sort of, you can hone in on any part of that supply chain. It doesn't have to just be the extraction part. But where do you see, I guess, just broadly, we don't have to get super specific, risks and opportunities there?
There's a very easy answer to that. For many years, these markets functioned off the only price available. That was the Chinese price, because the only meaningful volumes were changing hands in China, not in the West, and therefore the sort of Asian market price was a given for downstream operators in the West, who were more than happy to accept this sort of deflationary pressure that was generated by overcapacity and overbuilding through that, capital allocation that was offered below interest rates or below inflation and below GDP, generating this massive overcapacity. But that also means that the demand curve within the Chinese market is much more elastic. There is no reason for the Western world to accept that pricing because our demand curve is very, very inelastic. And therefore, you could have a completely different price incentive to rebuild that industry. What does it mean? It means that as we slowly are seeing attempts to recreate the non-Chinese price that would reflect our demand curvature, that's a massive opportunity for the valuation or revaluation of these equities. And in a way, it started slowly last year with the MP Materials deal that the US government engineered. Less so important for that company, more as a signal to the market that the government actually recognizes that issue. And we just very recently had a smaller deal between the US government and another earth company, Linus, an Australian company with operations in Australia and Malaysia, again, offering this price floor. It is necessary to do this, but I don't see yet the market being fully comfortable with this and valuing these equities accordingly with this sort of more realistic Western pricing. And the reason being is because really we still don't have volumes. We see certain signals from Rotterdam, for example, for some of these materials, but nobody knows really what the volumes are. So it's work in progress. And I think it's a question of transition. It's going to take a couple of years, and that's the window of opportunity for this investment.
Yeah, perfect. I love it. And honestly, it's so hard for me because like within that, as you're talking, I wish I could jot all of this down, but there's so many things to draw you out on there, Thomas, and again in a good way. But I guess I'll start, as we're talking about broadly the supply chains that have been built out and the nascent stages that the US and the West in general is currently in to rebuild those supply chains. Maybe we can zoom in a little bit and describe actually what we're talking about. So I encourage everybody to do this, but Thomas, you've talked about and written about a bifurcated commodity world, right? Driven by geopolitics. That's the driving force between that bifurcation. Now, honing in on exactly the differences in our two systems. So China's dominance in processing and offtake versus Western efforts to onshore, and you talked a little bit about this just now, to onshore or friendshore those supply chains. Can you walk us through a bit how you see China's export controls? I know those were recently announced. I want to say the end of last year, I think October-ish in 25, and there's been subsequent ones on top of that. But walk us through those export controls and processing dominance are how their processing dominance are rewriting the value chains for defense, semiconductors, renewables, et cetera.
Two separate things. One is monopolization, and the other one is weaponization.
Okay.
So let me start with weaponization, actually. So in 2020, China passed export control law. Most of us were just locked up, in COVID. They were, very actively preparing for the next stage of the trade war. Why weaponizing this particular sector as a tool of the trade war? Well, that's in itself is a good question. By then, by 2020, China already had over 90% monopoly in processing of heavy rare earths and gallium, and spheronized graphite, a little less, but still over 80% of tungsten, and there's a whole list of those. What happened since then, since October 2020, is that until that meeting you referred to in October 2025 between Xi Jinping and Trump and Busan in South Korea, there were 24 different regulatory screws that were tightened by Beijing gradually over not just the flow of the materials, but also the flow of technology associated with processing and refining and even extracting some of these materials, as well as related IP and even equipment related to processing. So it's a very comprehensive system, either relying on special licensing that allows Beijing to accumulate a lot of data about how the downstream is structured, and that's predominantly to better understand how much of that material ends up in dual use, if you wish, military applications around the world. So it's an enormous capacity to acquire data, and these days, of course, with digital tools, you can process these data, and probably Beijing by now has a pretty good overview of what's going on downstream there. Hence, a strong focus on the dual use. Sometimes even non-proliferation treaty was used as a fig leaf to prevent expansion. Tellurium, for example, around the world, or tungsten or something, many of which do not have half-lives that would be very concerning from the perspective of NPT, but that's the fig leaf that China has used. And so 24 different restrictions, most of them global. So not just US. There's often a mistake, when I hear analysts around the world say, oh, this is US-China problem, US-China problem. No, both in April of last year and again in October of last year, where China escalated again prior to the meeting with Trump, these restrictions were applied globally. And the largest consumer of many of these products is actually Japan, not the United States. But Europe has been also affected by this, as has been Korea, Taiwan, and others. And so that's the weaponization. And you mentioned that new ones have been added since then. So the meeting in Korea didn't resolve any of the underlying issues. China has retained the tool. It has only suspended 4 of these 24 restrictions for 12 months until November of this year. And since then, new restrictions have been slapped, this time specifically on Japan. And just 2 days ago, again, there was an attempt to reduce non-compliance with production quotas. Because what happened is that when 2010, China for the first time used rare earths as a economic or geostrategic tool in a dispute with Japan, which was not related to trade at all, territorial sovereignty over certain islands between Japan and China.
Right.
Subsequently, China lost that case at WTO on 2 occasions. And therefore, it was a question of tightening the system. Now, export quotas are illegal according to WTO, but China having a quasi-monopoly on some of these products moved simply from export quotas to production quotas. They could still determine how much was actually used, and by consolidating the sector in state-owned hands, they essentially had almost full control over what was really going on within the borders. Now, the question is how you seal the borders so that it doesn't leak out, as in 2010, this original case with which I opened my book, where actually smugglers out of China helped stabilize the market, and the prices went back to normal. Now, this is much less possible today, but there are still people in China who are trying to skin the cat here and find a way to make extra money. And that crackdown 48 hours ago today, it's an attempt to force or enforce compliance with those quotas, meaning essentially deprive the remaining smaller private operators, for example, in Jiangxi province, from any possibility to produce and potentially sell it in a way that's not condoned by the Chinese Communist Party, including overseas. So it's a sort of recurrent tool. Now, why does China need this tool? Well, of course, because their trade relationship with the outside world is so lopsided that it naturally leads to frictions with the United States, with Europe, with many others. China only has current account deficit, either with countries on whose commodities it's entirely dependent, or with countries whose technology it craves. So it's often South Korea, Japan, Taiwan, Netherlands, maybe until recently, and of course some commodity producers. But overall, its economic health relies on massive current account surpluses, because the economy is unable to generate sufficient domestic demand for all this overcapacity. It has to push that product overseas. Now, that would be okay for a small economy, but for an economy that's 17% of global GDP and 32 to 35% of global manufacturing is just simply not possible without massive frictions and attempts to push back. This is what US tried, and when it tried, China came up with those critical minerals toolkit to prevent any rebalancing of that trade relationship. And why does China need that borrowed demand from overseas? Well, it's a very heavily over-leveraged economy, 320, 330% debt to GDP, with very few other ways to actually unwind that. So reliance on on global demand is part of that, with massive negative repercussions around the world in terms of deindustrialization and general imbalances around the world. So as we're trying to reindustrialize, we're of course trying to reindustrialize also within this specific market, which has been monopolized and weaponized by China. It's a very important sort of key element of that process. I know that our government cares really mostly about two sectors. One is AI, one is critical minerals.
Right.
And to their credit, they've learned over the last year or so that this is a complex process, and it's a process going to take a long time. We started thinking that, America first can solve everything, but geology is not that easily onshored. So then we moved into bilateral agreements with many important parties, Australia, Japan, Malaysia, and others. Some of this is very, very useful for us because these countries have different strengths along the value chain. And then I think towards the end of last year, the most important signal was the big investment by Korea Zinc in Tennessee in a brownfields smelter project, because that would allow us to actually create physical recreate physical market. Because doesn't make sense to back, say, mining or mining development companies around the world.
Just have to send it back to
exactly to the PRC, right?
Right.
So that. And actually, PRC wouldn't even allow for this to happen unless they control the pipeline, because that's the way they're usually structured within sort of vertically integrated SPVs. I explained that in detail in my book. So it's really a process going to take many years. It's not something can be unwound so easily, because we wasted 3 decades on deindustrialization, and not all of the industry will be brought back. And of course, with automation and digitalization, things are changing as well. This is also an opportunity. And I'm not losing my sleep over, foundational research or applied research. We always, still number one or just about in the world. But the problem is the incapacity of the capital market, apparent incapacity, scaling it up beyond, pilot and demo plant to something that's large scale, because our capital market didn't do it for so long. Everything that's high level, high value in these sort of 3D widget making businesses, it, had long departed for Taiwan, Korea, or Japan, but that's okay. These are our allies. For everything that's a little lower margin but large volume, and that means much of the middle metallurgy, refining and smelting, that ended up in China, and continues because China continues to incentivize further buildup of that capacity. And there's nothing more damaging to the global metal market, in my view, right now than this next build out of copper smelters in Shandong that the market actually does not need at all. China persists in that policy of productive forces and modern industrial system, as the CCP calls
it. Yeah, that's quite the name. I always love the interesting names they like to put on. It always sounds so benign, but in fact, it's usually never so benign. Well, I love it. So again, tons to draw you out on there, Thomas. And I think, I'll start with something that you mentioned kind of towards the beginning, which is the export controls that were put on. And they're going to be on until I think like later this year, right? So October, November. And we made all these trades. I remember seeing and like reading about it at the time. It's like access to, high-end higher end semiconductors and chips, all this other stuff, just in exchange to keep the lights on, keep the critical minerals flowing to the US. So it's like, it does really just seem like a huge linchpin, a strategic linchpin in the system, that we just have to offer up so much. And again, it's just like, well, what's to say if, it comes to October, November this year, and okay, they're just like, all right, well, we're going to reapply the export controls. Like, what else are we going to give up? How much are we going to capitulate here? And that's a scary thing to me. But it is good. And the other piece that really struck me was, like, it's great to see the capital coming back into the space and the attention of both the capital markets, investors, and government, all three coming back into the space, which is great because, the U.S., to your point, it has really never had an industrial policy, whereas China specifically and these other authoritarian states have, because they're really important. Just those base materials are obviously a source of power and continue to be, especially as we enter a world of increased geopolitical volatility. Um, and to that point, I think it dovetails nicely with the next our next piece here, Thomas. So critical minerals are now explicitly tied to national security, arming armed forces, enabling tech supremacy, etc. So, as someone who's navigated the space for decades, Thomas, how has the narrative shifted from just, and maybe it never was, is kind of what I'm getting, but from a pure economic commodity cycles conversation, now shifting to very much in 2026 mineral wars, as we're describing with export controls and the like, in this new minerals global order, we'll call it.
Mm-hmm. Yeah, so it's always good to remember that, the other has agency.
Yeah, right.
And unfortunately, the premise of my book is that while we still believe that we're in sort of competition with a rival, a strategic rival, um, that rival didn't believe so. For them, it was a conflict. In the conflict, you're trying to do a couple of things. One is to retain the escalatory initiative, which is precisely what China does. And secondly, is to exploit asymmetries. And if you look at the kinetic conflicts of the 2020s, whether Ukraine defending against Russia, or now Iran defending itself, or a regime defending itself, asymmetry matters.
Right.
Asymmetry matters. It can actually hold off much more powerful neighbor or another hegemonic power at bay at a huge cost. The asymmetry that China applied in critical minerals, it's extreme. I think the naivete of our government early last year is that we're going to just reopen the trade war 2018 yet again without factoring in what China has done in preparation to this over 5 years since 2020 was a major mistake, because there's a big difference between us trying to sell them soybeans and us trying to buy from them rare earth oxides. Why
Right.
is that? Because soybeans are soybeans. They can go to Milei or they can go to Lula and buy it somewhere else. And of course, that's a leverage, whatever the small premium there is. But at the end of the day, it's the same price FOB and the same price CFR plus, right? With logistics and transportation and insurance. So $11 here, $13 in Ningbo. That's the difference. Not much leverage, especially if we are on the sort of demanding side here. With rare earth oxides, it's very different. The value of rare earth oxides at the moment of that negotiation in Busan globally in the market was about $6 billion. So really a drop in the bucket that normally you wouldn't care. But unfortunately, it translates into $10 trillion of underlying downstream value, industrial value, because what you
Exactly.
said about keeping the lights on, it's
Right.
exactly what it does. 47% of our electricity passes through permanent magnets that include rare earths. That's what it is. And
Right.
so that's a massive, 1,600 times leverage. That's what deeply underestimated by our government. So this asymmetry really matters. Now, other tools that we could apply there, are of that nature. I struggle to find them. We often raise the issue of semiconductor access and so on, but we talk about semiconductors, we're talking about something for tomorrow or the day after tomorrow, our digital future. Can China really, in large quantities, smuggle Blackwell NVIDIA chips and cluster them in southern Mongolia to distill Anthropic code? Yes, but this is still two steps behind, right?
Right.
And they do this. However, the difference with rare earths is that that's not about tomorrow. This technology has been around since 1982. It's about right now. Right now, you wouldn't be able to actually produce or manufacture anything.
Right.
So, and time matters, because as you rightly pointed out, we're concerned about the national security
Right.
and about geostrategy. And in this case, as opposed to wonderful 3.5 decades of globalization,
Right.
which I enjoyed a lot myself throughout my career. Now the time constraint is completely different, and that imposes this very important criticality on these minerals. How quickly can you get it? So I'm concerned after 8 weeks of this war that according to CSIS wasted between 1/3 and 1/4 of some of our precision weapons,
Right.
that at current programs, it would take us between 4 and 6 years, depending on the missile, to recreate that inventory. And I say, provided we get all the critical minerals for that. There's no guarantee for that.
Right.
Tomahawk is completely covered with gadolinium for electromagnetic warfare. Where are we going to get this gadolinium from? That's not a rare earth oxide that's being separated by anybody right now in the West, not even by the two operating facilities that we have in the West, one in Malaysia, the Australian one, and one in Estonia, the Canadian one. They don't separate gadolinium yet. So it's a big question mark.
I love that. I love that so much. I think about that a lot, and I've posted on our different channels here that exact point. And this is kind of like as an aside to the conversation, but I think it's really important to understand. So, I mean, we took the decision to start Operation Epic Fury. If you then, just at a very broad and high level, if you then don't affect the outcome that you want, the geopolitical outcome that you want, you've then wasted all of that. Just the missiles alone. I mean, we haven't even talked about like the human capital and the knowledge and the money and everything else, but just the actual inventory of missiles and ammunition and hardware, rebuilding that stockpile without affecting the geopolitical change that you wanted in the Middle East it leaves you in such a dire position going into prospectively 2027 or 2028 when I see you're wearing the Taiwan flag. Everybody says a potential Chinese invasion of Taiwan, right? And so you go in less armed, not having the manufacturing base you need to resupply very quickly. As you mentioned, time is really important. And it is, especially in a time of continued deglobalization. So all of these factors come together in a confluence to really play off one another. But then importantly, I think the U.S. is it's good that we're getting back in the game, but it comes at a difficult time, right? And so we are behind, especially on the critical minerals front. So
well, we are behind on many. Think about shipbuilding, right? Or iron, steel. I mean, there's just so many different front lines. But this is a good illustration why we actually have to rely on our allies a lot.
Yeah. Right.
And in this sector, I think if someone can help us with gadolinium, it's gonna be Japan, of course, right? I mean, those high-end magnets that can survive in very harsh environments, high temperature, radiation, and so on. I mean, Lockheed has not been buying this from China; has been buying this from Japan, and so we are really, really very interdependent. So how closely knit we are with our allies. That's one of the critical steps. I'm not sure always we're going in the right direction right now.
Yeah, I'd probably have to agree with you there. And the shipbuilding in South Korea, didn't we just sign? I think it was this week or last. The U.S. signed a big contract with South Korea and the companies over there to essentially outsource our shipbuilding to South Korea, which is good, but also bad because we should have that ability onshore in the U.S. I mean, obviously for, what is it? Geography is it's like the scourge of, I don't know, the scourge of the geography, right? So, I mean, like if something were to break out and that shipbuilding capacity is in South Korea, well, that's obviously a really long way from the U.S., right?
It's a very interesting point. So we and the West in general are over dependent on those three Asian countries that have never deindustrialized: Japan, Taiwan, and South Korea.
Yeah,
and different for different sectors, like memory chips in Korea, but logic chips in Taiwan, and so on. And you're right. Not long ago, I was in Nagoya in Japan, and I rarely transfer planes there, but this time I was sitting at a lounge, which is kind of a US themed lounge outside, very nice. So you have, not only Starbucks, but, Big Macs and a lot of sort of baseball paraphernalia and so on. And in the middle of this big hall, there's the fuselage of Dreamliner is hanging from the ceiling. And so I have a family there's asking my brothers, like, hey, so why is this Dreamliner here? And he says to me, well, because we build it here.
Wow.
Titanium, titanium sponge, titanium metal. We don't make that. Japan makes it, Osaka and Toho. So thanks to the fact that these three countries have not deindustrialize, there is a chance for us to rebuild everything from scratch. But you're right about geography, and I thought about it when I was in Malaysia visiting that rare earth facility. It's all good for the Malaysian separated oxides to be metallized in, say, Vietnam by a Korean company and then sent for further magnet making to Japan or to Korea. But what happens if there is a Taiwan contingency?
Right.
Malaysia gets separated from Korea and Japan. And you just mentioned shipbuilding. In a way, what you just said about shipbuilding brings back our focus on the Western Pacific. We are so dependent on the Western Pacific that probably the sooner we leave CENTCOM to their own devices and refocus on what really matters for us, especially our digital future that is so dependent on, Hsinchu Park in Taiwan, the better. The better for us and the better for humanity, really, because you don't want these things to be dependent on the Chinese Communist Party as they start creeping into our mind ever deeper with every day with AI advances. So
Yeah.
that's my ultimate scare.
Okay. That's actually really good to know. And yeah, again, as we're having this conversation, I came in obviously concerned about it, but I think I'm probably going to leave Thomas this conversation even more concerned about it than I already was. So this is great. But it is good. I mean, look, we have to point out where the blind spots are, where the soft spots are in our production and manufacturing capacity, and just be honest about that. Again, capital has to find its right home in the system that we live in, and to be dishonest about the conversation about where it's actually needed does a disservice to capital markets and investors to get actual return, and then also the national security priority as well.
If I can interject here, you're
Yeah,
right about
yeah,
the capital markets. So the difference between, say, China or the USSR before is their blueprint building this massive capacity with, state allocated capital, is that we have a capital market. And we
right,
have by far the world's largest, most efficient, most liquid capital market. We are not yet leveraging properly this amazing potential. We're not incentivizing our own capital, whether equity capital or indeed also on the debt side, to properly service the needs of this critical mineral sector renaissance. That's not done right now. Right now, there are a couple of larger players that are closer to the government that get this deal or that deal, and there's a little bit of murky area there how these things are dished out, and many of them with taxpayers' money. I don't think that's the best idea for us. We are a capitalistic system. We should incentivize, and for example, with the IR codes, investment in this area from the private sources with private funds and individuals and expertise rather than having a government with its obvious 2-year or 4-year electoral cycle dishing out taxpayers' money as if they were suddenly the best
right.
investment managers in the world. They're not. They're not. Obviously,
No,
they're not.
yeah, right.
So that's our strength. That's our forte, and we should actually play up that a lot more. And there are ways to do this.
Yeah,
Just
how would we do
puzzle.
that? What is the
Well,
solution?
yeah, I think the first thing, of course, it's looking at the structure of the industry, right? So on the mining side, you have this very long period of gestation of the projects, right?
Right.
From resource definition and conversion to reserves, and all the studies you have to do, and of course permitting and environmental thing, and then you're facing this massive capex wall for the project capex.
Yep.
Both on the equity side and for the debt and project capex, things could be done. First by tax incentives to back that equity, to reduce that cost of equity massively, especially if you believe that this Western pricing is going to be decoupled from the deflationary or involution, as they call it in China, price staged competition, which is always everything gets ever cheaper and cheaper and cheaper. Soon they will be paying people to get their EVs. So that's on the equity side. On the debt side, now, different solutions to this. I noticed that the Canadian government even wants to guarantee offtakes for, say, graphite companies that have been treading water for many years now. I don't think that's the ideal solution. However, backing the banks and backing the commercial loans for bankability of these projects would be a better solution. Now, one problem that we have in the United States specifically is that we don't have many of those mining companies here. And especially in critical minerals, there's nothing of the size that would serve as a consolidator, buying different projects. Although some of the moves here to support, say, 2 or 3 U.S. companies in rare earth space maybe go in the direction to sort of increase their currency and help them consolidate. But the reality is that most of the companies in this space are either Canadian or Australian, sometimes UK listed. The good thing is, and I keep drumming up at that point, is that our Defense Production Act Title III makes material sourced from Australia, Canada, and the UK domestic for our own economic security or national security needs. And therefore, we have already legislation in place to consider what's brought from Canada, Australia, UK domestic.
Like
and
legally.
Therefore, all
it can
we
be
need,
treated as such. Yeah.
All we need is to, make some tweaks maybe in the tax treaties between us and Canada. Is going to be fairly straightforward. Maybe with Australia is a little more complex, and allow our investors to actually deploy capital there rather than constantly doing what we seem to be doing, is just asking our partners, whether it's in East Asia or Middle East or elsewhere, to bring capital to the United States. We don't need that. We have a lot of financial capital. We need skills. We need human skills. We need human capital to rebuild many of these things. We need technology. And in many cases, the geology is where it is. And with all the kudos that go to the government for the Korea Zinc deal and a couple of others smaller like this, that refining capacity also is going to be sometimes in allied countries and not only here, right? And so reducing the cost of capital is really number one priority. And I don't think the government can just pull it off with taxpayers' money only.
Yeah. Okay. That's actually good, because that's always been the disconnect for me. And that's why it's super helpful of like, we have the conversations of with you and others of, okay, great. Cost capital's high. Again, there's like long lead times from start of the origination of a project all the way to finish. And then investors aren't making nothing in between, like a 5 to 10 year period, maybe even longer. Right. And again, if you could be investing
they get diluted, on their way.
Yeah,
and
exactly.
You're going through, down cycle in the market, and how much risk equity capital is going to be left there. And it's concerning, especially as we have, new demographic cohorts that are entering with very different 2020s behavior, right, in the market, meme driven and short term, quick gratification and so on. So we need to devise systems for more patient capital, and the tax code could achieve that.
Yeah, no, and that's great, because again, like that was always the disconnect for me. It's like, well, how do you bridge that gap? And nobody I've really talked to, there might have actually been a few, but there's like not a lot of good answers out there. And I think that, Thomas, was like the first time of like, hey, this is something that we can actually do that will affect change, right? And start to bridge that gap for a lot of folks and projects out there, and how our system brings money to projects all over the place, not just on U.S. shores, but as we legally classify them in those countries that you mentioned there as well. Fantastic. So, God, this is so great, Thomas. So commodity super cycles historically, and as we're discussing, are usually tied to industrialization waves, as you mentioned, in Japan and South Korea and others. However, in 2026, we're obviously in a time of deglobalization, and friendshoring, nearshoring as well. So we could probably pass over this one, because I feel like we're already chatting about it and have talked about it a little bit. But do you see a new super cycle of industrialization emerging in these older Western countries, or is it more regional to specific countries? So again, I'm thinking the UK, Australia, Canada, and the US, of course.
Yeah, so I think we have to redefine what we mean by cycles.
Right.
So just purely from the mining perspective, there are two that matter. One you're referring to, which is sort of capital cycle. So the pull from infrastructure and fixed asset investment into the commodity space. This is the big one. And the shorter cycles are the inventory cycles. And the real reward for a mining investor comes when the two are synchronized occasionally. So you have those hockey sticks events. I think what's different right now is that we are probably because you only see it a posteriori from history, so in 20 years, someone will be writing the economic history of 2020s. They will be able to define it. But I surmise that we are at the cusp of a different longer-term cycle called Kondratiev cycle. And so that's a massive technological transformation that only happens every couple of decades, is different from what you call a super cycle, which is just simply increase in investment, which sometimes is desynchronized, as it was the case of the last super cycle in the first decade or decade and a half of this century, which was really driven by urbanization in China predominantly. And as a mining company, that all you did was just to sell to China. It's not necessarily related to level of interest rates, because we had this the 2011, post 2011 sort of overheating, that even with very, very low interest rates, there was no massive infrastructure of fixed asset investment in the United States or in the Western world in general, especially the post the pigs crisis in Europe. So we might be seeing, with the massive investment into data centers and related energy assets and rebuilding of pieces of industrial capacity that were so dispersed around the world, in the world that we learned from the Japanese in 1980s, just in time delivery. We're moving away from that, so there's going to be some duplication. And it's possible that with new technologies and digitalization of a lot of these processes and robotics and so on, we might be seeing something completely different. It also means that different materials will be necessary for it. And the complexification of these technologies, that also changes. That last super cycle from the first decade to decade and a half of this century was very much driven by steel, therefore iron ore and copper and aluminum, and 2 or 3 other base metals. This is different now, because to build these things you would need gallium arsenide, or indium phosphide, or indium antimonide, or gallium nitride, or synthetic sapphire. And all of these things also come from the ground at some point and have to be refined and have to be purified and so on. But just different focus, because how complex the hardware that goes into this has become over the last, say, 2 decades.
I think in a future world, too, just to linger here quickly, is as you're describing, like, technology is getting more advanced, thus it's leading to a higher input of these different types of minerals they find around the world. I mean, you think this is just like, I don't know, theory crafting, I guess, but you got like 20 years, 30 years in the future, as technology continues across all different industries and sectors that all need and are pulling on the supply of globally of these minerals. I mean, you really have to secure access, or you just can't build your industries of the future of the next, I don't know, 20 to 30 to 50 years. Anyway.
Yeah, that's a good point. We see this.
Yeah.
I see this in the travails of the European Union. The European Union has just designed its investment accelerator act,
Okay.
something like that. So there are certain rules there for foreign investors, for FDI to say come into a 50-50 partnership, more or less, and share technology. Now, that would potentially affect EV factories invested by the Chinese operators, because as of summer 2024, one of those many restrictions that I mentioned, there's also a restriction on exports of Chinese EV battery technology. So whichever generation, of LFP batteries, which would make these factories in Hungary for sure, and prospectively in Spain, little more than maquiladoras, just assembly plants, often manned by Chinese workers, by the way, in order to leapfrog the tariffs, right? To sell the product, but the product whose entire value added is generated in China. And, will Europe push back or not? Don't know. It's very difficult. For now, it's still a consensus-based unit, although that might change soon, and it will be easier to achieve certain decisions. But at the end of the day, to what extent can this impinge on the sovereignty of decisions by, say, the socialist government in Spain, right, which is happy to sign a separatist deal with Beijing on that. But we see this already in other partners, other economies that are very closely connected to China, like Vietnam. Vietnam theoretically has this massive GDP growth, but suddenly the electricity consumption is not growing. What does it tell you? Well, of course, that this manufacturing process is, again, little more than maquiladoras, with most of value-added components coming through from China. The product is relabeled made in Vietnam, sent to the United States. It doesn't face the friction, the trade friction, and the tariffs that the Chinese-made products do. But in the meantime, what it means for local operators who had successful industrial companies is that they cannot compete with the cost base of that very, very cheap capital that's offered to those Chinese component makers within China, and therefore they exit the industrial competition and invest in real estate instead in Vietnam, which, as you know, in the longer term is not going to be a big winner for a country which is still, an emerging economy. So it's a massive problem globally. And coming back to what I referred to before, those decisions by the CCP have sort of negative externalities all around the world in various economies, not just ours.
100%. 100%. I love it. So I'm looking at the clock here, Thomas. I want to make sure I'm getting you out on time. Again, appreciate your time this morning. So as we wrap here, so macro-minded listeners and investors, obviously, I think you're probably one of the investors in that front. So what key signals, and we've talked about a few of them, tax code changes, capital flows and the like. So what key signals around policy moves, capital flows, M&A in mining would make you raise an eyebrow in the coming years in a positive way? What would be exciting to you to see in the space here?
So we will definitely see consolidation. You mentioned M&A.
Yeah.
Currently, so we set up this fund in 2022. And at the beginning, when companies come with projects to us and we're asking, like, why are you bypassing China? It's such a big market, right?
Right.
So fast forward 4 years, and everybody has this chart saying, we are rebuilding the Western value chain with whatever,
yeah.
Project in Brazil or Africa, somewhere else. But the size of these companies is like really cosmic dust, and therefore we need consolidation. And I strongly believe that within 5 years or so we'll be closer to the solution. Of course, provided there is no major kinetic conflict in the Pacific. But if we get there in relative peace, with the proxy wars elsewhere, but with relative peace, then we'll begin to see the structure of these sectors in the West being rebuilt. But it's not going to be 150 companies per material or per element crossing the finishing line. There's going to be, some kind of oligopolistic structure that will be developed on the other end of that success line, and therefore a lot of projects will be consolidated into groups, and we will see some winners. So the challenge right now is just to identify these winners, and therefore we don't really look at them at the potential investment opportunities completely on a standalone basis of a great team with a great project in the ground and a great technology to process it, but we want to see it within the context of the entire value chain. How does this plug into something else that's already being rebuilt now, rather than a promise of production in 16 years from now, which is usually what it takes from discovery to a large copper mine, open pit copper mine. So shorter duration and an opportunity to visualize those supply chains as independent from China within several years from now.
I love it. I love it. Now, Thomas, you've appeared on podcasts, including your own, obviously, discussing navigating global chaos and how, in your words, or maybe not in your words, but similar to how a new global order rewrites commodity investing. If you could advise U.S. policymakers on one lever, and we talked about one already, so taxes, right? But things like subsidies, permitting reform, things around capital discipline to counter China's critical minerals edge, what would it be? I guess outside of the tax reform.
Yeah, permitting reform, and you're raising something that was almost nailed in late 24, right, in the omnibus legislation, because one party won, a landslide across all the levers of government, they thought, a better deal could be engineered 2025. Here we are at 26, and we still don't have it.
Right.
So it's important, but it's very U.S. centric. However important it is, it's U.S. centric, and it itself doesn't solve other issues, courtroom, legal challenges and so on, which would definitely also deserve a solution. More broadly, however, I think what needs to be done, and it's sort of a package, if we identify those incentive prices for capital to move into the space, say some floor for the most important of these materials, we have to protect them in 301, Section 301, not Liberation Day stuff that Supreme Court struck down, but with very specific HS code specific measures, such as for graphite these days, for example, but then use the revenue from these tariffs to incentivize the downstream producers, those industries that still exist downstream, to move away from the cheap Chinese schlock through subsidies, gradually, financially, and then reputationally, and then give them a chance to wean themselves off the Chinese product over the next, say, 5 or 6 years or whatever needs to happen. Because otherwise, they are still sufficiently politically powerful against a very weak upstream industry in this country to push back, as they're pushing back on graphite, as they push back on steel in 2018, and so on. So you have to incentivize the downstream industry to start moving away from the Chinese product to ex-China product, of course, for economic security and national security, but because they consider their procurement systems as cost centers rather than strategic procurement like the Japanese companies do. They're very reluctant to move away from that Chinese dependency. So hopefully Section 301 would generate sufficient revenues to help them change their ways.
Fantastic. Well, Thomas, I feel like you and I could probably keep talking for another hour. So maybe I'll find you at some point in the future. But for now, we'll call it there. We'll get you out of here this morning. So, Thomas, as we wrap here, always like to do this. So where can folks find you? What are you working on? And what is new with Tomasz Nadrowski?
Still fresh is the book, Mineral War.
Love
came out, what is this, 3 months ago. So Mineral War, China's Quest for Weapons of Mineral Destruction. It kind of explains in more detail that we could cover today why we are where we are. And I think it's important to understand it, because otherwise we cannot design policies that could counter that weaponization of near monopoly in those sectors. So I would recommend anybody who's interested either in mining, minerals, new technologies, AI, military, or indeed in macroeconomics and how different rationalities impact the way the economies are structured, in this particular case Chinese ones, but also compare it with Japan, EU, and US. That book may open some doors to new way of thinking and conceptualizing that. On a day-to-day basis, Amvest Terraden Critical Minerals Fund, we continue to invest across 25, 30 different materials, upstream and midstream. It's an exciting time to be in this space because we learn every day something new. So it's very different from cookie cutter mining investment in the past that you just pick this particular gold company, that particular gold company. Here, the downstream and the changing technologies and substitution risk, all of this matters. So there's a lot of learning involved. So I would encourage anybody who's interested in this to reach out to the various professionals out there in this market and sort of educate yourselves, because it's probably a little complex for a generalist investor to dabble with these things, which also will tend to be very, very volatile. Let's face it, geopolitics is with us every day, and that affects the market and affects liquidity and affects volatility and so on. So you often have to trade around many positions that you might have a very long-term view on as an investment, but investment and trading are not mutually exclusive.
100%. 100%. There's even more I could dry out on there, Thomas. I really appreciate it. Thank you so much. And again, we'll link everything down below. So Thomas's new book, we'll check it out, as well as this podcast. and all of Thomas's links and where to find them. Again, Thomas, thank you so much for the time this morning. Really
Great.
appreciate it, my friend.
Thanks, Garrett. Thanks for having me. Thank you.